Money printing is never a solution, even the Fed knows this. However, it does a great job of devaluing the currency. You see, you can print money, you can expand the balance sheet, you can buy assets, but you cannot force people and businesses to use the money. The only way to do this is to give incentives. The book, Freakonomics, is a simple and easy to read look into how incentives work in the real world. As people are forced into consumption, spending, and foregoing savings, asset bubbles appear and a crisis becomes more exaggerated. This is where we're at today. You came here for the truth, so let me unveil that for you. Today I'm going heavy on the charts. It is the chart GPS you've tuned into. I want to look at what's happening with the velocity of money. I want to show you what's happening with the risk taking that's going on in the markets today. Clearly, every single day for the most part has been up, and it's been doing this for quite a while. You go back from March 2020 all the way to today, there haven't been many down days, and we have seen the result of this massive injection of liquidity into the system. But what's really happening? Are we in fact creating a bigger problem later? Well, I think we learned our lesson back during the financial crisis, but it's only for those who've been paying attention. I know a lot of individuals that have been buying up precious metals. They've been looking into land. They've been getting storable food and growing their own gardens. They've been paying down their debt, and they've been buying real assets of any and all types. And why are they doing this? Is it because it's going to be worth millions and billions and trillions of dollars? Or is it because they see the reality that's in front of us today and they are getting simple? Simple works. They want to protect their savings from what's happening with the central banks. If they admittedly, Ben Bernanke, 2002, say that they will devalue the currency and then they do the actions that devalue the currency, people wise up. So I've got a lot to talk about. Of course, I want to talk about the economic side. I want to look at what's going on with the stock market, everything in this one episode. Let's begin. As I said during the introduction, you can't necessarily force people to spend their money, okay? You can't push this into the system unless you actually pay them, put it into their accounts. They're gonna then go out, buy the plasma, LCD, LED TVs, whatever. They're gonna buy the latest iPhone. They're gonna do that. But simply by lowering interest rates, by buying bonds, that isn't gonna do the trick. So maybe we'll get there. Many have speculated that that's the case, but at this time, we haven't done that. The central bank activities are specifically designed to be stealth, to create inflation, to steal from the people to give to the globalist elite. I am showing you the velocity of the M2 money stock, the velocity of money. And what you're looking at here over the years is clear. It is distinct. And this has been going down and down and down. And during this period of time, interest rates have been lower. Why isn't the money moving easier? Why aren't people doing so with all of this free money that's been floating around? Well, you can see that during the past two recessions, this has declined more dramatically than throughout the so-called recovery periods. But right now, today, it has been like many of the other indicators, and it's simply, if you can't really see on there, it is essentially a waterfall. The velocity of money has gone off the cliff. And this just tells you that the actions that they are taking every day cannot be, it is impossible, it cannot be what their stated goals are. We want stable prices and we want low employment. And so they're buying up treasury bonds, they're buying up municipal debts, they're trying to purchase the biggest company in the world's debt. I mean, come on, who are you trying to kid here? You're not fooling me, and I know you listening, you're not getting fooled either. Stock lenders wince as hedge funds lose their shorts. Short selling has declined this year as hedge funds ditch bets against the relentless stimulus-driven stock market rally, prompting a drop in income for asset managers and brokers involved in such trades. Look, nobody's shorting the markets today. We know what's going on. When you've got, as they mention right here in this Reuters article, stimulus-driven stock market rally, this is going to create dislocations and distortions distortions. And if you bet against the market, you better know what you're doing, because you are essentially attempting to time something that clearly is very difficult. Now, for those who earlier this year timed it right, they made a lot of money in a short period of time. But in general, most people lose out trying to do that. So be careful. This is an article out of Real Investment Advice. I have this information and a couple charts to show you. They're talking about volatility. I have already highlighted previously the Federal Reserve, their admission of shorting volatility. We have a short position on volatility. I mean, that is coming directly out of their own website. You know that that's the case. Regardless, volatility since 2012, the favorite trade of bullish speculators has been to short the VIX. We know about this, and you could see it in this chart. VIX, non-commercial net positioning. And although, as it mentions here, we are not at the record of where it was, but right now there is some heavy speculation on this. And why? Because they know that the Fed is there. They know that they're pushing this down. You have to look at this. I mean, when we went into 2018, there was a big problem. And a lot of people seem to forget about it, but it was some heavy activity that resulted in the market declining pretty much across the board. And that was something simple like the VIX. And now today, they're doing the same exact things. It's an easy trade for them. When they're printing money, they are essentially pushing down the VIX index indirectly. And as a result, people are able to profit from it. Just like BlackRock, just like all of these other institutional investors, they simply copy what the Federal Reserve is doing, piggyback on it, and hope that they stay the course. This right here is the S&P 500, and what we're looking at is the index itself in the middle, but I also wanted to note the RSI at the top here. And there have been these repeating patterns. By the way, this goes all the way back from the 90s up until today. When things get too hot, when they get overbought, I know a lot of people say, oh, that doesn't mean it's going to go down. That doesn't mean it's going to go down. And I'm not saying that. I don't know why I tend to see that often, but just because there has been euphoria, there is a mania going on, doesn't necessarily mean tomorrow things are going to fall rapidly. But what it does tell you is that everybody's doing the same thing. They are all buying in. And suddenly, just as we saw back a few months ago, just as we saw other periods over the past couple years where there are major corrections that take place, you have to watch out for this in the short term. You may not care necessarily if you are going to keep your money into that Amazon stock. You're going to hold on to those 7 shares and you have no intention whatsoever of selling them. A 10%, 20%, or 30% swing might not necessarily mean anything to you. But regardless, this is one you should be watching out for. CBOE Options total put call ratio. It is right now not at a record high, but it is quite close. You can see that here on this chart. Just wanted to point it out. Real Investment Advice has this Pro series. They have some excellent charts. They actually create their own indicators, and this one I just thought was interesting. I wanted to bring it to you. Technical overbought sold composite, and right now it is essentially at a record high. We look at this time and time again where people are just piling into the exact same trades. They're all doing the exact same actions, and the market comes down by 5%, 10%, and everybody suddenly needs new underpants. And this is a problem because it tells you how weak, how fragile not just an individual's portfolio and savings and the plan that they've, or really lack of a plan that they've set up, but the entire industry, all of the amateur investors along with it. There's some information here about the economic aspect of what we're seeing in 2020. This comes from tracktherecovery.org, and it looks like in the bottom left corner showing us Harvard and Brown, I guess they are collecting the data. Recession has nearly ended for high wage workers, but job losses persist for low wage workers. But there's something that I wanted to mention because there is a problem that has yet to surface, especially if you're not looking into the actual details. Just imagine how many businesses have yet to fail. They're going to, they're about to, they're dealing with it right now. How many landlords will no longer be able to service their debt? How many lenders are going to deal with major failures? How many derivatives will spiral out of control as a result? We have got a major problem, and this is going to affect the financial sector. We're talking about those in higher salaried positions suddenly will lose their job. I don't know the extent of it, but I can tell you that there is going to be another problem here that we will deal with, and somehow it is never accounted for. This is some information in addition to what I've brought you not that long ago, but all of these movie theaters, everybody connected to Hollywood, Broadway, everything, they're all taking a beating right now. This is more information about AMC specifically. They said, and I quote, existing cash resources would be largely depleted by the end of 2020 or early 2021 if current trends persist. So they don't have the ability to pay for everything, essentially stating that either more customers need to come in or we need different sources of liquidity. I don't know what's going to happen to this company. It employs a lot of people, investors all surrounding it. And I think there's going to be more companies like this that are in a wait and see kind of moment and have yet to fail. And that will bring problems later on. I hope I'm making myself clear with, you look at the unemployment rate, for instance, it's never going to give us that full picture. In fact, I have some information related to the unemployment rate, so definitely stay tuned. I'll tell you about that in just a second. And then we have this, Encore at Wynn Las Vegas changes operating hours due to low demand. And I believe what it says, if I remember correctly, during the week, they're shutting down. Think about that. Las Vegas requiring more people to come in all the time, spend their money, and they're basically on temporary hours. That's not a good thing. Of course, we know that this will impact a lot of jobs. These businesses are not in a good position for the future, that's for sure. Okay, so if you want to look at what the fake unemployment rate is all about, I've done videos before, but you don't have to look into what I've brought you, all right? You can see this coming directly out of Axios, and they actually pull it specifically from Axios on HBO. Exclusive, America's true unemployment rate. But before I show you this, understand that there are different definitions for unemployment. What does that mean, unemployed? If I'm working 1 hour when I really want to be working 40 hours, am I unemployed? Well, some would say no, you have some employment, you just can't live off of it. And other people say that I'm making $6 an hour, I'm working, let's say 30 hours, but that total does not actually give me a quote unquote living wage. So it depends how you define it. They say in this article right here, as I've talked about so many times before, and I know you know this, I'm preaching to the choir, but the statistics are not accurate. They don't make sense. If you go in here, a person who is looking for a full-time job that pays a living wage, but who can't find one is unemployed. If you accept that definition, the true unemployment rate in the US is a stunning 26.1%. That's coming right out of here. I didn't say that, but I know specifically that the numbers are never accurate. Why it matters, the official unemployment rate is artificially depressed by excluding people who might be earning only a few dollars a week. It also excludes anybody who stopped looking for work or is discouraged by lack of jobs or by the demands of childcare that are going on right now. If you measure the unemployed as anybody anybody over 16 years old who isn't earning a living wage, the rate rises even further to 54.6%. That's where it gets a little bit gray area. What exactly is a living wage? All I'm trying to highlight is that the number that the government provides, the U3 unemployment rate, is not accurate, and in fact it's doing a disservice to the public. They explain how they actually come to this conclusion of trying to provide the U3 rate, how they lied to the people. If you want to check it out, you can pause the video right here or go into the link in the description. No shame. Illinois set to borrow from the Fed's lender of last resort facility a second time. Can you believe it? They're borrowing from the Federal Reserve's Municipal Liquidity Fund for a second time if a new U.S. stimulus package and a tax hike scheme for Illinois don't come through. The borrowing is significant since Illinois is the only state in the country to tap the MLF. Can you believe this? That is how bad the situation is right now in Illinois. We need to understand this. This resource right here, WirePoints, is always providing the data, and so definitely check them out if you want to see it. But you know what this is all about. They are actually making it worse every single year. I have heard from so many people they are dealing with a crisis, and it's going on right now. If you live in one place or another, you have one different industry that you're involved in, you're going to get a mixed signal. You're going to have a difference of opinion with others. There's always going to be pockets. I get that. But I have to point out what I see, and that's why people in the comment section need to provide what they are seeing. Let's learn from each other. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me simply by clicking a button on your screen. You support me. Thank you very much. If you want to learn how to sell stuff on the internet, if you're interested in e-commerce, I've created a free e-course to help out my subscribers. It's available at the amazongps.com. The financial system, it's complex, it's convoluted, it's like that on purpose. It wants to make you uneducated on the topic so that you have to go through their system, jump through their hoops in order to put your hard-earned savings somewhere. But I wrote these 2 books, simplified everything, help everybody out. Check it out at the link in the description if you want the audiobook instead, themoneygps.com. Wait a second, don't go anywhere. Have you seen this video? If not, definitely check it out. Lots of data, lots of info. Click it, I'll see you there.